Hey, good afternoon, everybody. Marty Missouri here for the second time today with a video commentary for you. Folks, this may be the quickest one you've ever watched because there's really not a lot to report on the economic update this week. And I want to keep it real quick because I really want you watching the one from earlier today. So when you have 16 minutes, maybe a cup of coffee or what have you, please take that in start to finish. I think that was an important presentation. This one is just more of the same. Our PWA index did not move on the week. It was flat. We did have two inputs that we brought from neutral to negative, U.S. retail sales and small business hiring plans. However, there were two market-based indicators that went from negative to neutral, which you'll see here toward the end of the presentation. As for the inputs that I want to share with you today, of course, retail sales to begin with continue to roll over, as you can see, on a year-over-year basis, and on a monthly basis, actually negative about 1% month on month. That's the headline read. When you look at core, which X's out food and energy, negative as well, about 29 basis points. Red Book comes out weekly. You can see it continues to just go down and down and down at a very low level historically. Online retail sales bucked the trend. Actually, we're up a little bit, but there's enough consistent negative here and certainly enough on a trend basis to have us officially move U.S. retail sales into the red for our index. Initial jobless claims also, along with retail sales, confirm what we anticipate, and that is a recession, or I should say odds really favor a recession in the U.S., we think, in 2023. Recall, we've done this a million times. Even though jobless claims are historically still at a low level, it's not about the level where they are, it's about the trend that you're seeing. And when you see jobless claims spike up from any level, like they are currently, you tend to see recession following, sometimes very shortly thereafter. And folks, that's what we're seeing right here. Small business optimism index came out, the National Federation of Independent Businesses. I did this on a chart of the day a couple days ago. Yeah, overall optimism, very low historically. Hiring plans rolling over hard. CapEx plans, right? Are they expanding or plan to really rolling over hard? Really nothing positive. I mean, you can dig in the weeds of any of these surveys, and I will dig into this one in more detail probably over the weekend. And I know I'll find kernels of maybe optimism here and there, but the general trend is one that looks very recessionary. Just look at how it tends to trend going into recessions historically. Cass Freight Index, in terms of shipments, rolled over. Expenditures are dropping. Of course, that's good news for inflation, but of course inflation is coming down, folks, as you'll see here in a second, because the economy is slowing down. And the stock market, which when I spoke at you earlier today, was down, and then it went down about twice as much from where it was, but it came rebounding back. The S&P only closed down 21 basis points, and the NASDAQ 100 only 19 basis points. And in no way, shape, or form should that surprise anybody, because clearly the market is still trading on, for the most part, this notion that bad news is good news, and that weak economic data is going to keep the Fed from raising interest rates, and I'm using air quotes, ideally cut interest rates later in the year, as Fed funds futures would suggest. If the Fed's cutting interest rates later in the year, I'm going to say it again, that's really, really bad news for stocks, because the Fed will not cut interest rates with stocks at these levels, or to put it more accurately or more pragmatically, stocks do not get to sit at these levels in a world where the Fed is cutting interest rates 3 times in the back half of 2023. That's when we're in a recession, and that's when corporate earnings are falling and stock prices with them. If we're right on our macro thesis, that's a high probability call. As I say every time, it doesn't have to work out that way. What has to happen for our purposes to take on more risk is that conditions and stock prices have to make sense together, and they don't right here. The CPI came out this week, and of course, it dropped, right? The headline reading went down to 5% on a year-over-year basis. On a month-over-month basis, 0.1. Wow, inflation's gone, right? Core inflation, when you take out food and energy, however, was up 5.6%, and 0.4% or 5% annualized when you look at it on a month-on-month basis. Again, though, I fully expect this to roll over this year because, again, I expect the economy to be weaker. When we come out of that, of course, clients, we have a longer-term thesis that says inflation is going to come back in a hurry when we come out of this coming recession that we think is going to happen. And that's going to be a real challenge for the Fed. We anticipate that whether they do it officially or they just do it, they are going to be adjusting the target for what they hope inflation to be above the 2% fantasy that just doesn't work in the world that we live in today and the regime change that I keep talking about that we're embarking on going forward. Producer price index really came down, right? On a month-on-month basis, down 0.5%, just up barely 2.7% on a year-on-year basis. And again, the market saw that as bad news or low inflation news being good news because of what it portends for the Fed going forward. If their prices are rolling over or they're cutting prices, however you want to put that, probably doesn't say anything really great about the economy at this juncture. Copper, on the other hand, has actually been really holding up along this resistance line. So folks, we are uber bullish copper on a multi-year basis going forward, not uber bullish copper as we sit here today, because copper we think will likely roll over with a recession, right? I know China is trying to reopen their economy. Its services sector seems to be pretty strong. The all-important manufacturing space in China hasn't shown the kind of strength that people expected. That may be yet to come, but if Chinese data doesn't start improving dramatically going forward, then that's just one other support for copper that would probably give way. And we have cut in our course some of our copper-related exposure, and that's still down from when we cut it, and replaced it with things like healthcare and staples, but we also added some Brazil exposure, which has turned out to be fortunate for us on a near-term basis, but we don't expect Brazil to have a great time in a global recession. We just know that their stocks are very cheap, their dividends are very attractive, and perhaps most importantly, their central bank pushed interest rates up to 13.5%, and they've had quite the run of late, and they were even up a little bit today because their inflation numbers are rolling over, and presumably, therefore, there's room for the Brazilian central bank to make the Brazilian government happy, who have been putting a lot of pressure on them to start cutting interest rates. So those reasons and more when you think about what we believe to be the pressure on natural resources for years to come, Brazil is in that part of the world that we like a lot longer term. Sectors, and this is just a 30-day look, tech has been just killing it. Well, suddenly it isn't. It's 98 relative to the rest of the S&P. Financials have picked up of late, so over 100 means they're outperforming the S&P. Consumer discretionary, notably underperforming, but materials have come back a bit. Energy has come back a lot relative to the S&P. Industrials are still underperforming. Staples are slightly underperforming now, the S&P. Utilities dramatically underperforming. It'll be very interesting to see how utilities do in the back half of the year. Healthcare, however, is still holding up pretty nicely. So this improved in our overall score because when you just look at it sector by sector, it's not quite as dire from an economic perspective versus what we've seen the last few weeks. Obviously, my view is that we'll see this go back to something that's more dire, but we score it as we see it. And today we see this particular signal as being slightly more optimistic on the economy than it has been of late. Same thing for the stock to bond ratio. The S&P has now gone from negative on the year to positive relative to TLT, which is the long-term Treasury Index ETF, which we actually use in our core portfolio that we're scaling into slowly. Certainly in a recessionary environment, if we're right, something like a TLT will have a pretty good go of it. And then lastly, the staples to discretionary ratio is still down on the year, and a signal that the economy is in pretty good shape is discretionary stocks outperforming staple stocks, or in this case, staples underperforming discretionary. So this ratio says that discretionary is doing better than staples, notably on the year. But from February 2nd on, it's been very much the opposite of that. So this says the market got way too excited about this year's prospects, or really found value or thought they were buying a real cheap sector when they were buying consumer discretionary. This line here says that there's potentially a recession coming and people are favoring consumer staples over consumer discretionary stocks. So folks, that's it. That's all I have for you today. Again, nothing about our economic assessment here has changed. Again, if you didn't get a chance, please go back and watch the earlier video where I touched on stocks, the dollar, and gold. Hope you have a wonderful weekend. Really appreciate your attention here on these videos, and I'll talk to you again very soon. Take care. Bye-bye.